Alright, picture this. You open your investing app, red everywhere. Your portfolio is down 14% in what feels like 5 minutes. Your stomach does that weird drop thing. You tell yourself you're calm, you're long term, you've read the books, but your thumb is hovering over the sell button like it has a mind of its own, and you're thinking, I just want this feeling to stop. If that's you, look, same. That moment right there is where more wealth gets destroyed than in any crash headline you've ever read. Here's the thing, market dips don't actually make most people poor. The decisions people make during market dips do. And today I want to walk through the 5 worst money moves people make during market dips, why they feel so rational in the moment, and this is where it gets really interesting, how you can flip those exact moments into long-term advantages instead. But first, my name is Tom, and I spend way too much time thinking about personal finance, investing, and how normal people accidentally sabotage their own money. If you're someone who panics when markets drop, second guesses every investment decision, and feels like you're always one step behind financially, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now let's start by challenging a belief almost everyone has. Most people think the biggest danger during a market dip is the market itself. That's wrong. The biggest danger is you. And I don't say that to be insulting. I say that because the data is brutally clear. Over a 20-year period, the average stock market investor underperforms the market by about 3-4% per year, largely because of bad timing decisions. Buying high, selling low, panicking at exactly the wrong moments. 3% doesn't sound like much, right? Here's what most people don't realize. If you invest $10,000 and earn 8% annually for 30 years, you end up with about $100,000. If you earn 5% instead, just 3 percentage points less, you end up with about $43,000. That's a $57,000 difference from emotions. So let's talk about the first and worst mistake. Mistake number 1, panic selling just to stop the pain. Look, I get it. When markets drop, your brain is screaming at you to do something, anything. Selling feels like control. It feels like relief. But here's what's actually happening in your head. Losses hit about twice as hard psychologically as gains feel good. This is called loss aversion. Your brain treats financial losses like physical danger, same stress hormones, same fight or flight response. So when your portfolio drops 20%, your brain isn't thinking, ah yes, expected market volatility. It's thinking, we are under attack. Now you might be thinking, okay Tom, but what if this time is different? What if it keeps going down? Fair question. Let's look at actual history. Every major market crash, the Great Depression, 1970s stagflation, Black Monday, the dot-com bust, the financial crisis, COVID, every single one eventually recovered and went on to new highs. Not eventually like a little better. Eventually like massively higher. Here's a simple math example. Imagine you invested $100,000 right before a crash. The market drops 30%. You're now at $70,000. Painful. If you sell, you lock in that loss. But if the market later recovers 43%, which sounds huge, but is mathematically just what's needed to recover from a 30% drop, you're back to $100,000. That recovery doesn't require genius. It requires not sabotaging yourself. Here's the thing most people don't realize. The best market days tend to happen right after the worst ones. Miss the 10 best days in the market over a 20-year period and your returns get cut roughly in half. And guess when people miss those days? Right after they panic sell. This is where it gets really interesting. Selling during a dip doesn't just hurt you today, it permanently resets your financial future lower. So what do you do instead? Actionable step. Before the next dip, and there will be one, write a 1-sentence rule for yourself. Something like, I do not sell long-term investments during market downturns. Not when you're scared, not when you're emotional. Write it now while you're calm, because future you cannot be trusted. Mistake number 2, waiting for certainty before investing again. Okay, so maybe you didn't sell, great. But then comes mistake number 2, sitting in cash waiting for things to feel safe again. This one is sneaky because it feels responsible. You're telling yourself, I'm just being cautious. But what you're really doing is waiting for certainty in a system that never offers it. Here's the problem. By the time the headlines turn positive, the market has usually already recovered a large portion of its losses. Markets are forward-looking. They move before the economy looks good. So when you say, I'll invest once things stabilize, what you usually mean is, I'll invest after prices are higher. Now, you might be thinking, okay, but what if I wait and buy lower? Sure, in theory. In practice, almost no one does this well consistently. Let's say you had $50,000 sitting in cash during a dip. The market drops 20%. You feel smart waiting, then it drops another 10%. You think, see? Good call. Then it rebounds 15% in a month. Now you're frozen. Do you buy now? What if it drops again? This is how people end up sitting on the sidelines for years. Here's a real example. After the 2008 financial crisis, many investors stayed in cash well into the recovery. By the time they felt confident again, the market had already doubled. That hesitation cost them more than the crash itself. Actionable step: instead of waiting for certainty, use rules-based investing. For example, invest a fixed amount every month, no matter what, or rebalance your portfolio once per year, automatically buying what's down. This removes emotion from the equation, because emotions are terrible financial advisors. Mistake number 3, stopping contributions at the worst possible time. This one hurts. When markets drop, people often say, "I'll pause investing until things improve." That sounds logical until you realize what you're actually doing. You're choosing not to buy assets when they're cheaper. Think about literally anything else you buy. If your favorite shoes went on sale for 30%, you wouldn't say, "I'll wait until they're more expensive." But that's exactly what people do with investments. Here's what most people don't realize. Your contributions during market dips often end up being your best performing dollars long term. Let's do simple math. You invest $500 per month. When the market is high, that $500 buys fewer shares. When the market drops 25%, that same $500 buys 33% more shares. Those extra shares compound for decades. Stopping contributions during a downturn doesn't protect you, it robs future you. Now you might be thinking, okay Tom, but what if I'm worried about my job? That's valid. This isn't about being reckless. If your income is unstable, focus first on building or protecting your emergency fund covering essentials. But if you're still employed and cash flow positive, stopping investments during dips is usually an emotional decision, not a financial one. Actionable step: automate your contributions. Automation turns investing into background noise instead of an emotional event, because willpower is unreliable. Systems aren't. We've covered panic selling, waiting for certainty, and stopping contributions. But now we're getting into the mistakes that feel smart and quietly do the most damage. And that starts with mistake number 4. Alright, let's keep going, because the next 2 mistakes are where things really go off the rails. These are the ones people defend the hardest. The ones that sound intelligent at dinner parties. The ones that make you feel like you're being proactive and when you're actually making things worse. Mistake number 4, going all in on safe assets at exactly the wrong time. This is the classic move. Markets drop, fear spikes, and suddenly everyone becomes obsessed with being safe. So they dump stocks and pile into cash, bonds, gold, whatever felt stable last decade. And look, safety isn't bad. The problem is when and why people chase it. Here's what's happening psychologically. Your brain hates uncertainty more than it hates bad outcomes. When stocks feel unpredictable, safe assets feel comforting, even if they lock in lower returns. Now, you might be thinking, isn't reducing risk during volatility just smart? Here's the thing, risk doesn't disappear just because something feels safe, it just changes form. Cash feels safe, but it quietly loses purchasing power to inflation. Low yield assets feel stable, but they may not grow enough to support your future goals. And here's what most people don't realize. When markets drop, expected future returns actually go up. Prices are lower. Long-term upside improves. So when people rotate into safe assets after a decline, they're often doing the exact opposite of what math suggests. Let's put numbers on this. Say you're 35 years old with $200,000 invested. After a dip, you move most of it into conservative assets earning 3%. If inflation runs at 3%, your real return is basically zero. That decision doesn't show up as a dramatic loss. But over 20-30 years, it can cost you hundreds of thousands of dollars. This is where it gets really interesting. People often say they're being conservative, but what they're actually doing is increasing the risk of not meeting their future needs. Actionable step: instead of reacting emotionally, define your asset allocation before a downturn. Decide how much volatility you can tolerate, how much growth you need, then rebalance back to that target during dips, buying what's down instead of fleeing it. Mistake number 5, trying to outsmart the market with perfect timing. Ah yes, the final boss. This is where confidence sneaks in. After watching markets fall, some people decide, this time I'll time it perfectly. They start following charts, news cycles, influencers, gut feelings. They tell themselves, I'll get back in lower. I'll know when it's the bottom. I'll be smarter than everyone else. Now, you might be thinking, isn't tactical investing how professionals make money? Here's the uncomfortable truth. Even professional fund managers with teams, data, and decades of experience struggle to beat simple market indexes over time. And individual investors with jobs, stress, and emotions. Yeah, timing the market consistently is one of the hardest things in finance. And here's what usually happens. You sell after a drop. The market rebounds faster than expected. You hesitate, waiting for another dip. It never comes. You buy back in higher, or worse, stay out entirely. This cycle doesn't just hurt returns, it destroys confidence. And once confidence is gone, people stop investing altogether. That's the real damage. Actionable step, replace prediction with participation. Instead of asking, where is the market going next? Ask, am I consistently investing in productive assets over time? Because wealth is built through time in the market, not timing the market. Let's zoom out. Market dips are inevitable. They are the price of admission for long-term returns. But most people don't lose money because markets fall. They lose money because they panic sell, wait for certainty, stop investing, hide in safe assets, try to time the bottom. Every one of these mistakes is driven by psychology, not logic. Fear, overconfidence, the need to feel in control. Here's what I want you to remember. You don't need to be fearless. You need to be prepared. Preparation looks like clear rules, automated systems, long-term perspective, accepting discomfort as part of the process. Because the people who build wealth aren't the ones who avoid volatility. They're the ones who don't let volatility control their decisions. If this video helped you see market dips differently, hit the thumbs up. It really does help the channel. And if you want more content on investing, psychology, and building a financial life that actually works in the real world, make sure you're subscribed. Markets will dip again. Next time you'll know exactly what not to do, and that alone can change your entire financial future.